Well, folks, it was the big day. Yeah, the big day. Down over $91,000 in the public account here today. $91,573 to be exact. We knew it was coming. Meta stock down over $88,000 here today. I will say it could have been a lot worse, and I mean a lot worse. After hours yesterday, Meta stock got down to $400. It opened today at $425 and then came back throughout the trading day. So I guess $88,000 is a win today, down 88. I mean, I guess we'll take it. Nasdaq didn't get hit that hard today, considering Meta's move down 0.64%. So I thought that was actually a win for the Nasdaq as well. After hours, Google stock is up big, over 11%. Microsoft stock is up very nice as well. Palantir's making a nice move upward, and there's no real news after hours in regards to Palantir. We will speak about Palantir in this video here today, okay? Now, 5 core subjects I want to speak about here today in this video. First off, I'll speak about Google's earnings and Microsoft's earnings, kind of give you my thoughts on those earnings, where they're really as good as they kind of seem with those after hours moves. Then we're going to get into basically a company that is very, very bullish, okay, in regards to those earnings. Then we'll speak about the third subject will be Palantir. We got some huge things happening for Palantir here. Two major things, in my opinion. Very, very bullish for Palantir. Fourth thing we're going to get into is Apple and Risk next week with their earnings. They do have, it's almost like a no-win situation for Apple. I'll kind of explain what's going on there. And then the fifth thing we're going to speak about is Amazon looking bullish. Amazon's earnings are on Tuesday. Is the stock going to run? Like what are things looking like for their 3 businesses? So we'll speak about that in today's video, okay? Appreciate y'all joining me as always. Hope you appreciate me making you guys a video here today, even though I was down so much today. My feelings are hurt. Smash a like for your man. It's the only thing that can make me feel good on a day like today. I appreciate y'all, and also make sure you subscribe to the channel. If you're looking to apply to join my private group, get access to all my course curriculums, access to 6- and 7-figure Discord chat, all that good stuff, that's going to be the pinned comment down there here today, okay? Alrighty, so let's get into my thoughts on Google and Microsoft before we get into the other subjects. So Google McDougal, if you look at that income statement, it was a grade A income statement, very impressive. Revenues, 80 billion plus, 69 billion in the same quarter last year. Cost of revenues went up quite a bit, but I mean, if your revenues are going up that much, it's still very, very impressive. Research and development was up slightly for the company year over year, but only 500 mil. When your revenues are up over 10 billion and your R&D is only up 500 mil, that's pretty impressive for a tech company. Sales and marketing actually fell for the company year over year. That's incredible. General and administrative was down about $700 million year over year. So let's get this right, okay? If your revenue is up that substantially and many of your expense line items are down, guess what your profitability is going to do? It's going to go to the moon, right? And that's exactly what we have seen play out here with Google McDougal. Income from operations over $25 billion versus $17 billion. Net income, $23.6 billion versus $15 billion. And if you look at EPS, $1.91 versus $1.18. Incredible, right? If we look at the balance sheet, top 5 balance sheet in the world in regards to Google, absolutely incredible, right? And that just, they've had a top 5 balance sheet in the world for probably 10, 15 years now at this point in time. Now, on top of that, they also announced their first ever dividend. It's kind of funny because Meta announced the dividend last quarter. Their stock goes crazy. It was up like 20%, the next day. And then Google watches all that play out. And they're like, man, our stock's been a little stagnant, especially if you compare it to Meta over the last couple of years. We need to get this thing moving. They announced a dividend. They also, if I recall, they have a big share buyback as well. Now, Mr. Softy, phenomenal earnings, another grade A here. Product revenue about $1.5 billion year over year. Services revenue $44.7 billion versus $37 billion in the same quarter last year. Total revenue $61 billion versus $52. Cost of revenue, they kept all that in check. Gross margin dollars went to $43.3 billion from $36.7. R&D was up for the company, sales and marketing was up for the company, G&A was up for the company, but everything was kept very in line, which is what you would expect from Satya Nadella. He does a heck of a job running this company. Net income went to almost $22 billion from $18.2 in the same quarter last year. $2.95 EPS versus $2.46. That's a grade A income statement right there. Now, in regards to Microsoft, the guide came in a little light, just like Meta's did, right? They called for $64 billion in revenue for this next quarter. Analysts were at like 64.5, so slight miss, about a $500 million off, which was basically, right exactly what Meta kind of got it for their midpoint. They're about $500 million off of the street as well. Now, they also say currently near-term AI demand is a bit higher than our available capacity. Very, very bullish, okay? Microsoft has been increasing its capital expenditures to secure Nvidia's graphic processing units for training and running artificial intelligence models. So that leads us into our second thing here, right? Which is this very, very bullish stock, and I talked about it yesterday. It is Nvidia. So now at this point in time, we've had Tesla, Meta, Google, Microsoft, all basically saying we've got to spend on AI, right? And so any thought process that was out there about maybe the AI spend's going to slow down, maybe these companies are going to cut CapEx or something, there's 0% signs of that right now. A year from now, it could be different. 3 years from now, it could be different. 5 years from now, it could be different. But as of today, there's zero, like Robert De Niro, zero signs that companies are cutting. They're spending as much as they can on NVIDIA chips, and it's going to be like that for quite some time, folks. And I believe NVIDIA just gave their first H200 to guess who? OpenAI. And so all these companies are just loading up on H100s right now, but at this time next year, they're all likely going to be loading up on H200s. And if you don't buy those H200s, you're going to fall behind your competitors. So it's an arms race. It's an arms race at the end of the day, and all the big tech companies out there are all involved in this, and the smaller tech companies as well. Now, if you're wondering who's the best buy out of Meta, Google, Microsoft, I mean, just factually, statistically, it's by far and away Meta, right? Google, great company. Microsoft, great company. But if you got to pick one, you got to pick Meta. Meta's got the cheaper forward P of the stocks. They're, I would say, arguably the most diversified of all those business models. And the third component, right, is this company's growing at a much more rapid clip than Google and Microsoft. If you look at Google's numbers, if you look at Microsoft's numbers, both those companies are growing less than 20% their top line. Meta just came off a quarter where they grew that top line 27%. So much stronger growth. Then we could obviously go into Meta's founder-led. Zuckerberg still leading that company. And, no disrespect to Sundar Pichai or Satya Nadella, but there's only one Zuckerberg, right? And so, at the end of the day, you compare those companies together, and it's Meta's the best buy of the three still at this point in time, right? Now, for the next, which stock does better for the next 3 weeks or 3 days? Who knows? It might be Google or Microsoft, but I'm thinking about the next 3 years, and there's no question Meta's the most well-positioned. And that stock's done by far and away the best over the past 18 months out of these three, right? I don't see any reason why over the next 18 months it won't do the best as well, right? By the way, 1000xstocks.com, we just had our 290th person join the wait list. If you want to get in that first 300, you can go to 1000xstocks.com to get on the wait list there, okay? So Palantir, let's talk some Palantir here. Palantir, usually a very talked about stock. Usually a lot of info coming out of Palantir. Things have been a little bit quiet recently, okay? And ever since the stock made its big move back at the very, this called early February, stock's kind of just been chilling out, just chilling, not really doing much, right? But there were some interesting articles that came out 2 days ago on Business Insider, Bloomberg, about Palantir's secret weapon, their boot camps, right? And it's fascinating. They were writing Palantir has been leaning into the events to sell its artificial intelligence platform, or AIP. The company put on over 500 boot camps last year and expects to average 5 camps a day globally this year. And a lot of people, by the way, feel like AIP is really just a Trojan horse to sell potentially Foundry. So I don't know. That's just, a thought process that's out there. Alex Karp, we can't do enough of them, he said in the last earnings call. We're limiting the number of people who can come in. It's like a rock concert. It's like, yeah, if you know somebody, you can get backstage. We're already overfilled for our AIP boot camp, he added in the earnings call. And it's just, we don't know how to deal with this actual demand. Still, one thing Palantir is hoping that people do who attend the boot camps is go away knowing how to use the tools, right? That's the whole purpose in signing up for Palantir's products, and how to show others how to use them. But some analysts think they need to do more to support growth. Right now, they need more manpower, says this analyst, right? Now, I thought Amit on X had a really good kind of insight on this whole situation here. And I just want to read you briefly two things he wrote here, okay? Amit says, first, our boy Rishi, with a $5 Palantir price target, says he's skeptical of Palantir's bootcamp strategy scaling without hiring a traditional sales force. Kevin Kawasaki, Palantir's global head of business development, answers his concern by explaining that they can't try to grow with a traditional sales force in a linear way because their demand is exponential. What does that mean? Palantir can't just hire 500 salespeople and ask them to make 50 calls a day. That's not how you sell software like Palantir. But even if you did, it would not capture the amount of demand they are seeing from clients. These clients want AI. They want to see it in action. So boot camps are the best way to sell. However, this is the part that blew me away. Some customers who attend a Palantir boot camp can then turn around and host their own events for their own customers, allowing the model to proliferate indefinitely. This is called an infinite money loop, as I call it, okay? Palantir, the company that could not sell, has turned their go-to-market strategy into a network effect. J.D. Power is already using what they learned from boot camps to host one of their own, which will only further show Palantir's software and how to compound the growth of people learning how to use it and eventually buy it from Palantir. I do not see another company on the stock market that has turned a huge weakness, selling, right, which has been the thing that's talked about as a weakness of Palantir, not the product. No one's ever doubted Palantir's product. The only thing people have ever really doubted with Palantir is two things: valuation and their ability to sell the product. Dare I say, proprietary moat because of how hard it is to effectively copy and scale software boot camps. So 100%, and we're going to get to see that in the numbers this year. What type of growth rates is Palantir putting up? We got a glimpse of it last quarter, 70% growth, U.S. commercial. What are we looking at this year? It's going to be very, very exciting. Now, additionally, on top of that, here's the situation, okay? Mr. Softy just told us they can't even keep up with their AI demand, right? So if they can't, what about Palantir? Palantir is set to be the company, or certainly one of the companies that is most well positioned to really capitalize I would put them kind of into a SaaS space, right? Software as a service in regards to AI, right? They've been at the cross sections of data and artificial intelligence before everybody was talking about AI, right? And so they're just so well positioned. And analysts have the company doing 20% revenue growth roughly this year, around there, right? And I'm just looking at it, I'm like, hearing what Microsoft has to say, hearing the talk about the boot camps, having this continuous spread this year, I have a hard time thinking they're only going to grow 20% this year. I mean, I think there's a realistic possibility maybe this company puts up a 3 handle or above when it comes to revenue growth for the full year. We'll see. But very, very exciting times, I think, to be a Palantir shareholder, and earnings are coming sooner rather than later. I will be live streaming Amazon's earnings, by the way, on Twitch, and I will likely be live streaming Palantir's earnings on YouTube, or not on YouTube, on Twitch as well, when that earnings does drop, okay? Next up here, let's talk about Apple's risk for next week, and then we'll get into, is Amazon looking very bullish going into next week, okay? So, here's the deal, okay? If we think about the Mag 7, all the Mag 7 stocks, except one, is respected for AI, right? Google is, Microsoft is, Nvidia is, Amazon is, Tesla is, and Meta is. One company is not respected for AI, and that company is Apple. Now, this is the quarter where Apple is expected to likely talk about how they're going to spend for AI. Now, if you think about Apple's shareholder base nowadays is really focused on profits, earnings per share. It's a lot of the Warren Buffett type folks, right? They're not buying Apple stock for major growth. They're not thinking about how does this company grow revenues 20% next year, 30%. They're thinking about it as Coca-Cola, as Pepsi stock, as, somebody drops their iPhone, they go buy another iPhone. Somebody needs a new iPad or wants a new iPad, they go buy another iPad, right? It's not like I'm going to go buy some other product. So they think about it in terms of this ecosystem. People like it. People continue to use it. It's stable. It's dividends. It's share buybacks. It's profits. But the problem is, We're now going into a cycle where you're going to have to spend aggressively. And this is where it leads into a very confusing time for Apple. So let's say Apple announces, you know what, we're going to start taking this AI stuff really serious. We're going to start spending heavily on AI. All right. If you're going to hire people, right, a bunch of new people to work on AI systems and experts on this, those people are going to be very expensive, and those people will hurt your earnings per share, right? There's a big cost associated with that on your income statement. Now, on top of that, it could also hurt your cash balance, because if you're going to spend a bunch of money that you wouldn't have traditionally spent on CapEx for infrastructure, so let's say Apple's going to spend an extra $10 billion in infrastructure this year, which, by the way, that's not even a big number for CapEx. $10 billion is not actually going to get you as many chips as you think it's going to get you from Nvidia and all the other systems you need, okay? So, but let's just say, hypothetically, Apple's going to spend another $10 billion on CapEx than they would have if it wasn't for AI. Well, that means less money for then share buybacks and for dividends, because there's only so much money to go around, and especially for Apple right now, because Apple's having trouble growing their top line, and Apple's kind of been running their business very lean, so it's not like they have a lot of employees they can cut because they've been running their business so lean already. So they're stuck in a real pickle here. Now, let's say they don't. Let's say they don't spend, okay? They don't announce any big spend on AI. Well, if they don't have some sort of big up on their AI spend, then people can look at that and be like, Apple's not taking AI serious like all the other Mag 7 stocks. They're going to stick themselves as being the loser in this space, right? Which is not going to be very comforting for a lot of the long-term investors. Now, does Warren Buffett care if Apple's a leader in AI or if they're irrelevant in AI? I don't think Warren Buffett cares. But I can tell you there's a lot of other people that do care. And we'll look at Apple and say, if you're not spending, like, what are you going to spend on? Because this is just kind of another loss for the company, right? We know Apple Car has failed. They've exited that product. From what we hear, the Vision Pro product is failing. If you guys have seen the news in the last few days, they're cutting down their shipments massively. From what I heard, it's like 50%. It's awful. I did tell you guys that was coming, right? I told you guys when that product was released, they totally got that wrong. Apple should hire me because I'm like, well, they screwed up so bad in regards to that. I'm still like, my gosh, like the price point, they messed it up across the board. I don't even feel like getting into that right now, right? I called that out months ago. But they're in a no-win situation because whichever way they go, they're going to be looked at as, this is bad. You want to spend a ton? Okay. Buybacks, dividends hurt. Maybe your earnings per share is hurt if you got to hire a bunch of people as well. You don't spend, you're an irrelevant big tech company. And people are going to look at you like, what are you up to, man? You're not doing anything. So I don't know how Tim Cook's going to handle this situation. I'll just be honest with you. I wouldn't want to be in his shoes. They lagged on this big time, and now everybody's looking at them, and they're going to be like, what are we doing here with AI? No bueno, no bueno. So what does that mean for Apple stock? I don't know. We'll see. But I don't think it means good things. I don't think it means good things. All right, next up here, or is Amazon looking very bullish? So first off, in regards to me with Amazon, I'm going into this earnings with 1,055 shares in the public account, assuming I don't buy any between now and Tuesday. So it's a pretty big position for me overall. So you got to think about Amazon in regards to three core businesses. You got to think about them in regards to e-commerce. You got to think about them when it comes to cloud, AWS. They're the big dog there. So the big dog in e-commerce is the big dog in AWS, and then they're a big dog in advertising, but they're not the big dog, right? That always goes to Meta and Google. They're always recognized as the big dogs in advertising. So the question is, do we have any tells on if these businesses are likely going to have performed great or not? Well, we do. We have tells on all segments, actually, based upon other companies' earnings, so we can kind of figure out, is Amazon going to likely come in with a really strong earnings? So if we think about the advertising business, right, it's going to likely come in stronger than expected. Based upon Meta's growth rate of 27%, based upon Google's growth rate, which looked very, very strong, it looks like the advertising business for Amazon should be very, very good for this particular quarter we're going to go into. Now, keep in mind, in this quarter, there's no football season in that particular quarter, right? That actually matters for Amazon because in football season, they have Thursday night football. So they don't have that right now, but at the end of the day, advertising business should be very, very good. But what about big dog, AWS, right? This is the profit machine. This is a cash flow machine, AWS. Well, if we think about AWS, if you look at it's AWS, then it's Microsoft, right? And then down below that, it's Google. If we look at Microsoft's cloud business, if I recall, the numbers were up 30% plus. So Azure looks very, very strong. Google Cloud also looks strong. So my guess is AWS should look very, very strong as well, because I do not believe Microsoft and Google are necessarily stealing customers away from AWS. I believe all these companies went through a period of cutback from some of their customers, and AWS is the biggest, so they got hit the hardest. When companies went to cut back on spend in 2022 and into 2023, AWS got hit by far and away the biggest, because they are the biggest. So if you're the biggest and customers are trying to figure out how to save money, you're going to get hit the hardest, right? And so AWS got hit the hardest. So as growth accelerates again, right, which it should in 2024, and Andy Jassy kind of already bottom called, in my opinion, the cloud business, the biggest beneficiary on a dollar amount basis should be Amazon. That doesn't mean they're going to have the highest growth rate from their cloud business, but the biggest dollar amount should by far and away be Amazon. So don't be surprised if AWS posts the best growth we've seen in many years. Just to be quite frank, maybe the best growth we've seen since 2021 in regards to the cloud business. So that's looking really good. So we got two big businesses that look really good. But what about the e-commerce business? Well, you've always kind of been able to tell if the e-commerce business is healthy based upon Meta's revenue specific. I've never really seen it where if Meta revenues are bad, Amazon's e-commerce business is good, or vice versa, where Meta's e-commerce business or Meta's business is good and then Amazon's e-commerce business is bad. Generally speaking, if Meta's advertising business looks great, then Amazon's e-commerce business looks great. And a lot of people that are actually Amazon sellers can run ads to Facebook, Instagram, these different products. So being that Amazon just came off a quarter of 27% revenue growth, right? I believe that there's a high probability the e-commerce business for Amazon is doing tremendously well. And I think that growth rate could actually surprise as well. So here we are in a situation with Amazon where they're probably going to beat expectations on the e-commerce business. If I had to put odds on it, I'd say probably 90% probability on all three of those. Probably a 90% probability they're going to be on e-commerce. Probably a 90% probability they'll beat on AWS, and probably a 90% probability they'll beat on advertising spend. So that all bodes very, very well for Amazon. And so what you should likely see is significant beats when it comes to revenue and when it comes to earnings per share. And you should also see incredible growth on a year-over-year basis. You could see some of the fastest growth in these businesses for Amazon that you've seen, honestly, since probably 2021, which is going to be very, very exciting because Amazon's growth rates had been a little sleepy the last couple of years now at this point in time. Okay, so I'm looking very forward to Amazon's earnings on Tuesday. And you might say, well, what about the risk of this being like a Meta type situation here, right? And sure, that's a risk of like, what if they report good numbers, just like Meta did, and the stock still goes down? It's certainly a risk, but Amazon hasn't really been a hot stock. If Amazon is like at the same price it was back in like 2021. It's not like a Meta that had ran huge and was up like 400 or 500% in a matter of 18 months. Amazon stock kind of hasn't done anything for really years at this point in time in terms of, if you look back since 2021. So it's not like it's necessarily a hot stock riding into these earnings. But if they come through with great numbers and great guidance, good conference call, the stock's positioned to go well over 200 for the first time ever. And who knows, maybe approach a 225 number very quickly in regards to that. So we'll see how it all shakes out. But based upon all these other tells, I think Amazon's looking pretty dang good. Now, next thing I want to talk to you guys about is all these earnings are coming out left and right? Metas and the Googles, and we're going to have Amazon, we're going to have Apple coming, right? Microsoft, Palantir is going to be coming, Shopify, all these companies. It's very exciting, right? And there's a lot of action and there's a lot of things to talk about. And I love earnings time period because there's so much going on. It's like action-packed, it's fun. But the one thing I'll say to you guys is stay focused during this time period, because this sort of time period we're going through right now, earnings season, right? You can get very distracted by short-term stuff that's going on in businesses and get very short-term focused on, oh, this business is so great, this business is so bad. You can be influenced to sell stocks if the companies aren't reporting good earnings in the short term, or if this company's hot, you might be, more inclined to buy it. Don't let any of the short-term stuff cloud long-term visions in regards to stocks, long-term investments, okay? Businesses go through ups and down cycles, and one time a business is like, the hottest thing since sliced bread. The next minute, no one wants a piece of that business. And it's up for you as an investor to kind of like just take a step back sometimes, and just say, what are the trends over the past year? What are the likely trends over the next year? And ask questions like that, find out things like that, research things like that, not just focus on what's the hot thing in that particular quarter, because it's very easy to get wrapped up in it. I mean, you think about Tesla, right? Tesla, 3 years ago, the hottest stock in the market. Everybody wants a piece of Tesla, right? And then you fast forward to going into this earnings time period, and you would have thought it was the worst stock in the history of mankind, the way people were destroying that stock, right? And the way people were talking about it. It's got to crash another 50+%, all these sorts of things. And during that short-term time period, there's so much negativity, it can lead you to kind of like get into the short-term mindset about, what I'm seeing today is what you're seeing today is not the only thing you're going to see. This is something you got to keep in mind. Like I said with Tesla, 3 years ago, if a lot of people could see was growth, and it's going to be a $10 trillion company, what I could see was problems coming over the coming years, right? And that's why I exited the majority of my position. Now, I see a lot of opportunities over the coming years, right? So you got to differentiate between what's going on for the next 3 months with the business versus what's going on for the next 3 years for a business, right? And if I look at a Tesla, I think the next 3 years are incredibly exciting for Tesla. If I thought about the last 3 years, I thought it was going to be a tough 3-year span, and we had a very tough 3-year span, right? And so these are just some kind of food for thought, guys, in regards to this. Don't get caught up in the short-term numbers. It's important you look at it. It's important you pay attention to what's going on with these companies, but don't think what you see today is what's going to happen forever. I can tell you, if we had a major recession, these companies wouldn't be putting up this sort of growth. If we have a major recession, all these big techs will likely cut back on AI spend, which would hurt Nvidia, right? That could change numbers. We don't have that right now, but if we ever did, there's just a little food for thought there, right? We saw what happened to these companies' growth rates in 2022 when the Fed started raising. I mean, my gosh, they got cut heavily. And so that's just a little food for thought there, guys. Stay focused on the long term. These are things I, preach to the private group a lot. And it helps folks out tremendously because it's so easy to get caught up in the short term. And you don't want to do that. All right, guys. So if you're looking to apply to join my private group, pin comment down there. We see if we get you in. And once you hit 6 figures in your portfolio, we'll send you over this beast right here, the Heavy Diamond Award, to your house, complimentary. And then once you hit 7 figures plus in your portfolio, we'll send you over Big Dog right here. Oh yeah, baby, Big Dog. And then once you join us, send you your Steel membership card. This is a 2023 edition. I got a 2024 over here. 2024. Oh, there we go, baby. I got a 2024 here for you guys. Yes, the 2024. And it's a little different than the 2023. The stock chart is a little different. They're 2 different stocks. Not a lot of people that knew that or picked up on that. The 2023 and the 2024 are actually 2 different stocks. And if you know what 2 stocks these are, you're special. That's all I'll say about that. Special, okay? All right, guys, appreciate you joining me. Much love as always, and have a great day.